Good afternoon. Welcome to episode 4 of Optimum Live. I've got to pre-warn you is that, as you can probably imagine, accountants have a rather busy time in January. I've already seen Mike first thing this morning, and let's just say his eyes were almost the colour of the corporate colours on this banner. I can tell you they've had a tough old time as usual, but still committed. We've got 2 of them that are here, and we're going to talk about 2 different subjects this time, so let's get them in. Welcome to you both. Let's start with you, Hannah. Welcome. You're from the sat in the Cheltenham office at the moment, I believe, aren't you?
I am.
How have you been this January? Is it quite as mad for you, or not quite as bad as the others?
I have not had it as bad as Michael. Michael has worked his socks off, bless him. It's been okay. This time of year comes around every year, and best thing clients can do is get us their records. Absolutely.
Agreed. Absolutely, no question about it, and it does pay. Now, I'm scared to ask this of you, Michael. It's been a tough January getting everybody's information in, hasn't it?
Yeah, it's probably been the worst one for a while, actually. Now, I don't know whether there's sort of more external factors that are pushing people's delays in getting stuff in, or whether it's I don't know, whether we had a good way for a while and it wasn't as bad, but this year kind of pushed it a little bit too much. But there's our little violin, like we said last episode, there's the little violin.
But it's relative, isn't it? Because we did talk on I think it was episode 3, wasn't it, about like get the details in as soon as possible so that you can work through them. Beneficial to me as a business owner or in my personal side, because then I know what's going to be expected of me in advance. In reality,
that's it. Yeah, we delivered some unsavoury tax bills to some people last minute because they'd only brought it in a week before. And then interestingly, I saw a post from another accountant on LinkedIn with the final week and the every year kind of bingo card of questions that's being asked, going, so hypothetically, what if I had done this and this? It's like, well, yeah, it doesn't matter, you didn't do it. So your tax bill is still that. And why is it so much? Well, because you earned so much. Why didn't I have more time? Well, you didn't bring it in. And it's just like a bingo card, and we had them all this time. It's all right.
Yeah, hopefully lesson learned. I know I learned from them myself, is the kind of going, I want to get everything in and know about it. So, but the good news is it's now February the 1st. So in theory, at least the bulk of that work is done. Well done to the team at Optimum. And let's look forward. And I know that you've been up relatively bright and breezy this morning because we were at the networking event at Blunsdon House Hotel. Impressed that you were there, Mike, I have to be honest.
Liz was surprised, wasn't she?
She was cross wires there somehow, wasn't it? But well done, mate. You were there. Right, we're going to cover two distinct areas, two totally different areas. One is understanding personal tax payments, including how to save for them and all of that sort of stuff. And the second one is to touch on tax efficiency of electric cars. Very, very complicated points. Let's start with the personal tax. Now, you're going to have to let me know which one of you is going to speak each time, because I don't know who the half of these should be aimed at. But personal tax, I mean, how do I open this up? How does it work? What do we really need to be aware of with the personal tax?
So the main thing to realize with personal tax, it affects everybody. They all have and there's two sides to it. There's generally speaking, there's income tax, and then could be capital gains tax, but it all kind of gets wrapped up as the same thing. When it comes to someone in your situation, it's tax at the end of the day. It's payment, but it relates to your income. So whether that's employment income, dividend income, interest, property, all of those things, it all essentially comes under this one banner.
Okay. And I mean, I've raised two distinct questions to start with. One, we kind of touched on how does it work? The other is when does it work, which we were already kind of touching on at the moment, is that we know deadlines, including my wife delightfully had a bill to pay yesterday, but can it be done sooner on the personal tax as well?
Yeah, so the tax year ends the 5th of April. So you have from the 5th of April to the 31st of January to get it in, get the tax return into HMRC and get it filed. So you've got 9-10 months to do it. You can't do it straight away, generally speaking, because you're waiting for a few bits of documents to come through, either from mortgage companies or from P60s, P11Ds from your employer. And they're just like your end of year tax forms. So sometimes you can't do it immediately. We do have a bunch of people who turn up on the 6th of April, and go, can you do a tax return? I want my CIS rebate. So those are in the construction industry. And then it's anywhere from then onwards, they start dribbling through.
Fair enough. And I mean, Hannah, from your perspective.
So I think in terms of timing, Mike's exactly right. But what you can ask your accountant to do is help project what your position is going to be. And this will help you know what your exposure is. A, you can be proactive, do something about it. And B, you can save some money up in order to be able to pay it. So I think those are the two most important things that you can do and that we could help you with.
Yeah, and I mean, that was a key message that we were wanting to address today, is about how we can save for it. Now, how and when can we save it? Is this separate to payment on account?
Yeah. Well, you go, Hannah.
Okay. You do the bit first of trying to forecast where you are, and then you can go, right, these are what my payments on account are. So, I wouldn't pay money too early, because they're not going to shake your hand for it and give you much back for it.
No.
That's it. So everyone incurs tax every month, whether you're self-employed, got dividends, got rental, you incur tax monthly, but you only pay it twice a year. So you get a lot of people when they start into being self-employed, they go, I don't have to pay tax for 18 months. And yeah, you're absolutely right. You don't physically pay it for 18 months or maybe even a bit longer. But you when you get to that payment, you got 18 months of tax to pay in one go. So that's the most common misconception with people starting into businesses. I don't have to pay it for that long. Whoopie-doo, lovely. It's great going into starting self-employed. But then when you go along, go, right, so you got this and your payment on account. So for next year's tax, and we can get into that bit in a bit. But it's like, oh, that's I wasn't expecting that. And it's like, no, well, you were earning money monthly, so you do need to save monthly for your tax. That's the most sort of risk-averse kind of approach, is going, well, if you make $2,000, put 200-300 quid in the bank to cover your tax bill.
Yeah, and don't forget about those extra bits either. Sorry, there's a lag on here, so sorry if this is disjointed from my side. It's my internet connection. Don't forget about the extras. Student loan. If you've got student loan repayments, that's going to quickly add up. That could be a shock on someone's tax bill. So those extra bits that you've got as well, make sure that you're considering those.
Yeah, and I mean, does that mean, just picking up on that figure you said, is that you talking around about 10%? Did you say put in?
Yeah, it's just there's depending on your circumstance, you can do a quick calculation and work it out what your percentage is. Some people do it on what money comes in to how much to save. So some people have got the fintech banks like a Monzo bank, and they've got it preset that the minute money comes in, it pushes so much percentage that you want into your savings account to save for tax into your pot, and it works really well because people just see it go straight away. But what that percentage is different to every person, and it depends what type of income. So as we go into it with talking personal tax, you've got different rates of tax. So you've got the likes of employment income and rental income. They form a 20% if it's in your basic rate band, or 40% if it's in your higher rate band. Dividend income is in your basic rate band is 8.75. In your higher rate tax band is 33.75. And then you've got some slightly higher ones if you're earning some big boy money. So you can, depending on what your income is, it depends what percentage to put away. And again, like Hannah said, student loan, unfortunately, I'm still paying mine off. So I got to put a bit extra away each month just to go into the pot for that to pay annually. So again, that affects the percentage, but it's quite easy. If people on regular income can kind of work it out, and if it's not on regular income, you've got the software that you're running all your accounts through that you can do a quick calculation on.
Yeah, because I know that my wife, she's now employed, so she doesn't have to worry about it. She's POIE, it's all taken care of. But she was self-employed, and she was putting, I never really asked her how much, but she was putting a percentage straight into a savings account, and it would all be ready for the payment on account, or thereabouts at the very least. So there wasn't a big shock. So I guess the reality is that you're probably needing to be aware of what percentage to put in. And is that something they can speak to you guys about to understand how much they should save away?
Yeah, absolutely. And it's generally speaking, a lot of people have got a similar trend of income year on year out. So we, like for a bank of clients, we've done their 7th tax return in a year, and most of them have been very, very similar, maybe up and down around the COVID times, but on a like for like basis, it's similar. So you can give them a rough percentage, and you can give them a slightly higher one and say, look, this is more than you need to save, but at least when I tell you a tax bill, you've got a little bit left over to treat yourself at the end of the day when you're paying HMRC their birthday present.
Yeah, absolutely. I mean, it's really weird, Hannah, is that I'm listening to that and sort of going, right, so if I've got dividends, it's 8 point something, and then that percentage, and if I'm employed earning that much, it's that. I mean, it's a lot to sort of try to take in and be disciplined. And picking up on Mike's comment at the beginning, you go, oh, great, I haven't got to pay for ages. It's quite a minefield to know how much to save away, but it pays, doesn't it? Because everything is so much later. I always get lost in going, right, so I'm paying for now? No, for 18 months ago. Oh, right, I earned that. How much then? You've got to stay ahead of the game.
Yeah, absolutely. And it's not just, oh, this is what my earnings are. You've also got to consider things like child benefit, because if you say husband and wife claims child benefit, you, husband, your income goes over 50K. Are you going to know that you now have a charge because your income, even though your wife is the one claiming the child benefit, your income has exceeded 50,000. So therefore there's now a charge, will you know that? By sitting with your accountant and having these kinds of conversations, getting ahead of the game, you'll feel more relaxed, and we'll be more relaxed because we know we're not going to give you a big bill, because that's hard for us to do. We really dislike doing it, genuinely.
Yes, it's never going to be a nice conversation, is it? And I guess, there lies why it pays to get it in as early as possible, so that you then, what's coming. What did you say, Mike? 10 months ahead or something like that?
Yeah, at the best, you could be 10 months ahead, but with being reasonable, 6 months ahead, that's not unreasonable to get it in by sort of July time and have it done by then. Because also with the payments on account, if you get it done in July, you know whether that payment's going to be high or low. And we can, it might be a good segue into payments on account now anyway. But where you pay every 6 months for those on self-assessment, your second payment comes out in July. Now, if you know what your income is, if say your income has dipped in this year, your payments on account are based on last year. So you could end up overpaying at a time when you haven't got the income. So where last year, say your percentage tax was 30%, this year, because your income's down, but you're paying tax on last year, it could be like 50%. And that could be really putting a strain on someone's personal finances. So again, if you get it in, I like to get those people in way like before July to go, look, let's get it in. Let's do your tax return to know whether that July payment can move or not and come down.
Yes, and I mean, and I'm not sure which one of you should I go to this, just to make sure that everybody understands. Apologies, I'm sure you do, by the way. If you're watching, feel free to put comments and questions. We can put them up on the screen as well. What is payment on account, and how does it work in simple terms? Which one of you should that go to? I don't know.
So clients see the payment on account as the devil. Because they're like, why am I paying tax up ahead? I have sympathy, but I also try to play the middleman here. So essentially, when you do your earnings up to April and you pay your tax in the January after, okay?
Yeah.
And if you're over £1,000 a tax bill, okay, HMRC are interested in you. Essentially, it's worthwhile them asking you for some more money. If you're below it, it doesn't really affect their budget enough, right? They've already spent it. So you get to January and it goes, right, you are 10 months through the tax year, okay? So we want 6 months of tax relating to that year. And you go, and so actually from a cash flow point of view, it seems to make sense. You've got 10 months of income, you're paying them 6 months of the tax. And the way it works is it's based on 50% of last year's tax bill. Okay, so you do your tax to April 23, and let's say that comes out at £4,000. Okay, you got a £2,000 payment on account for the next year. So generally speaking, once that happens, every 6 months you pay your £2,000. Okay, the problem comes is if you haven't made a payment on account yet, you have your total £4,000 in this example, plus your payment on account. So at that point, you go, I got 18 months of tax. And that comes back to that first point of going, yep, you got 18 months of tax, but you've had 22 months of income for that tax in that time scale that it relates to. But that's where people have spent it because they see, like myself, I've spent it. When I first got onto dividends and stuff, I had my savings building up, and then I went and bought a caravan. And then the tax bill came round, I went, how am I paying for that then? Because I spent it, because it's sat there. And that becomes the problem with self-employed. You're paying it every 6 months. But that's how the payments on accounts work.
Fair enough. I mean, Hannah, that makes sense. Question I've got then, it's going to be a really stupid question, and people watching will probably laugh at me for this one. Am I right in assuming that it means you don't actually have a choice? When HMRC, thy will be done for payment on account, then thy will be done.
Yeah, you'll pay the payment on account. If you don't pay it, then you'll get interest. Or if you pay too little, you say you've lowered your payment on account because you can apply to do that, and you pay too little. By the time you get to the end of the tax year, they go, oh, you didn't pay enough in July. What they could do if they wanted to would go and charge you some interest. So you need to be and that stops people from playing around with it too much. But it is, I think when people first start as self-employed or dividends, it can be a bitter pill to swallow that you have to pay 1.5 years tax. A lot of people feel really robbed by it. But I think if you get over that hurdle and then you plan properly, payment on account actually works out quite well because you're parting with your money. It's like a little pot, right? Okay, that's bit's done. It's not such a huge lump sum then in January.
Yeah, no, it sort of like seems like a double-edged sword, doesn't it? It makes sense, but it also is going to hurt somewhere along the line. Therefore, and I'm going to come to both of you on this one, if you, and we've probably already covered it, but in a succinct manner, starting with you, Hannah, what's your best advice for somebody that are just starting along that route, both in terms of saving and payment on account and everything?
Forecast and save monthly. Even if you can't put your finger on it exactly, maths isn't your thing. You can see the money that's coming into your bank account. You see those numbers, put some aside. And make sure you have an accountant before December.
Yes, yes.
Minimum.
And what would you put the percentage? What would you kind of go and put away if you were or what would you advise someone to put away, percentage-wise?
I think it really depends on how much that person is earning, but being really prudent and to really put yourself in a good footing. You could get somewhere between 15 and 20%. That's going to make your payments. Then you're going to kind of scoot along, and you're going to be quite if you can do that. 10%, I think, is minimum.
Okay, that makes sense. Mike, the same question to you, if it hasn't already been said.
Yeah, save monthly. I do it myself. Put it away. Tax bill comes, I pay the bill, and that's done. I don't. Although I hate seeing the money going, the same as every client goes. I just say, look, make sure you buy yourself a bottle of wine when you're going to go do it. But drink the wine after you made the payment. I don't want anyone blaming me that they paid the wrong account because they were drunk. But yeah, just save monthly, a little bit. Even if you do a little bit, it will soften the blow if it's a bigger tax bill than you were expecting. And the sooner you get it in, the sooner you know, the sooner you can plan what to do.
Yeah, and I guess you sit there and kind of go, yeah, my wife's now employed, so hers is just on a pay slip, it's all taken care of, all sorted. She still puts a tax thing in because obviously she's linked to my businesses as well, and it's just checking all of those things. But generally speaking, if someone's employed, they kind of go, oh, it's so much easier, I don't have to think about it, it's just done. But it's worth going through all of this with all of the benefits of that you're able to work bits and pieces out, and it's if you're going to get a benefit, you've got to put the work in as well.
Yeah, and it's remembering, people think just because it's employed, you're done with your taxes, but you could have two people husband, wife, and a family that are employed. But if one of them earns over 50k and they got child benefit, they've got a tax to pay. They have to do a tax return, but they don't realise because they're on PAYE. So we get a lot of situations where someone will knock on the door and say, we need your help. I've had a bill for 4 years worth of child benefit. It's 10 grand or 8 grand. Like, I didn't know I had it. And because they don't know. So people assume that just because they're in PAYE, their tax is sorted. It's not necessarily. It depends. Again, it's that on the fence scenario of it depends. It depends on your circumstances. And it could be that you earn very well and you got money in the bank and you got savings. And at a certain point, you need to do a tax return to declare the savings. So it's small earnings and stuff. Like, up to now, it hasn't been a problem. Most people wouldn't ever come under it. But where the interest rates are going up, it's surprising actually now what interest is being kicked out. And therefore, some people need to account for it on their tax return now.
So what would we be saying for people in that situation then? Should we say, right, yes, you're employed and you wouldn't necessarily have thought to go to an accountant. Should they, or are they able to do stuff themselves?
Everyone can file a tax return themselves. You can go on the HMRC portal, register yourself, and you can file a tax return. You just follow their questions through. We're able, if we were to do it on there, because we know the questions, we could probably do one in 10 minutes. It might take someone else 2 hours to read through the questions, understand the terminology they're doing. But with anything, HMRC give you the tools to do it all yourself. You don't have to go down the route of an accountant or a tax advisor, but they're the ones who are going to know maybe a little bit more, but nothing stops. So I get quite a few people come along. They've done their own tax returns for years. There's been no problem with them at all. Absolutely no problem. They just then want the peace of mind that it is being looked after.
Okay, I mean that's really good to know, because I think I was a bit naive to that one. And Hannah, your key benefit for that is that you wouldn't have any of those horrible conversations telling people they owe a lot of money.
No, absolutely. I think if you're going to try and work things out yourself, using the example of the childcare benefit, HMRC's website isn't particularly clear when it comes to the charge. When your income goes over 50k. So use other tools around. Citizens Advice, great tool, has got some really good articles on it that are in real plain English and on one page rather than flicking next back on HMRC's website. You can always use things like that.
Okay, I mean that's a good point and good bit of information. On the personal tax, is there anything from either of you that we haven't covered that you think we should touch on?
make sure it's paid by the end of Feb if it's not paid already, because HMRC have put a 5% charge on your late payment tax. There's one, as well as the interest. So
Is that still the same if you've got a time to pay with them?
No, that's a good point. No, if you've got a time to pay arrangement, you've arranged that before the end of Feb, then that avoids the late payment penalty, but you still pay interest.
So what's that, Hannah?
Time to pay. So if you weren't able to settle your tax bill before last night, you can make an arrangement. It's called a time to pay arrangement with the revenue. You can apply for it either online, just pop in time to pay, HMRC into Google, it'll take you over to the website, or you can give them a ring, the number also is on the website. And you are then entering into an agreement with the revenue of, I'm going to repay this much back, over X period of time, and therefore my debt with you will be settled. And the interest hike, the large interest hike that Mike's citing there won't be applied.
But presumably there is some kind of fee in effect that's, for going that route.
You pay your interest at 7.75 or 7.5% per annum, but instead you don't get the penalty of the 5% for being 30 days late, and then it increases over time.
So basically, don't be an ostrich and bury your head in the sand. There are ways through it.
Yeah. Just speak to HMRC. I've got quite a few clients who had that big tax bill this last week, 10 days this month. And they just logged online or phoned them up. They got a payment plan for 10 months, all sorted, peace of mind. But if you go be an ostrich and you bury your head, it's going to get worse. It's not going away. It's not going to disappear. So just get on, deal with it. And actually, HMRC are pretty reasonable of making an arrangement for you, regardless of the level of tax. They are understanding.
And what are the periods of time they give you? Sorry, Hannah, the periods of time they give you as options?
Yeah, again, different circumstances, different amounts of tax, different taxes are different rules as well. So essentially you have a conversation with them, they go through the questions, they ask you affordability and bits like that, and you come to an agreement. At the end of the day, they want someone to come forward and pay something, even if it's monthly, rather than ignoring them for 6 months and then either going bankrupt or going away. They'd rather get something going, an agreement, and actually help you than hinder you.
Agreed. And Hannah, sorry, you were going to say?
No, that's okay. Exactly as Mike said, if you are going to make an arrangement for time to pay, when you're ringing up, make sure you're equipped with all of the affordability stuff. So, what your outgoings and stuff are. Generally speaking, as far as I'm aware, revenue want to get repaid within 12 months. Of course, though, depending on the tax, as Michael said, there could be extraordinary circumstances. God forbid, your husband's very ill or something like that. They're humans still at the end of the day, all right? It's all done on, each case is done on a merit. You don't necessarily just fall into this box or this box. For them, it's, can you afford it? And when are they going to get paid by? Those are the two things really that they're looking for.
And you have to do it as a taxpayer and not the accountant to do it. The calls we get are, oh, can you phone up and sort my payment plan out? Nope, not allowed.
No, exactly. But I think that's an important distinction, and for some people might be a revelation, is that they are human, and they genuinely are. If you phone up and speak to them, they are human. They are there to help. And I think that's a valid point, is everyone just assumes they're the big monster coming to take their money. And it's like, well, they'd rather make sure they're going to get it at all than bring the guillotine down now. That doesn't do anybody any favors at the end of the day, does it?
Correct.
So that makes sense. Okay, I think that covers everything on the personal tax side of things. Sorry, go on, Hannah.
Sorry, before we move on, I'm just going to kind of add to what I said earlier. You asked me how much to put aside and save, and I gave my answer between 15 and 20%. Just be really careful, because sometimes what shoots us in the foot when we speak to clients is, my mate down the pub said, right? So my mate down the pub might actually have a limited company and extract dividends and pay tax at a lower rate than you do with your sole trade, where you pay tax on all of your profits in year. He might just be talking about his personal tax. He might also be talking about corporation tax. Go speak to your accountant. It's great having a chat down the pub and getting information. But yeah, speak to us and we can tell you how much.
That guy down the pub is one of the most intelligent people, it seems, because he always comes up with something like this.
He does. He does. That's normally you're normally that guy down the pub, though, Mike. To be fair, if you had the energy.
Yeah, I've got to stop wearing this. I'll stop asking questions.
Yeah. Hey, I'm impressed that this show we're not actually toasting a drink on this one, are we? Unlike last episode, pre-Christmas.
I know, I missed out.
You did. You definitely did. Right. Let's move on to electric vehicles or electric cars and their tax efficiency. This one I find really interesting because it's not black and white, it would appear, by any sort of sense whatsoever. Who do I come to first on this one? I mean, I've got a first overriding question that is, how tax efficient are they? Are they definitely the right way to go for everyone? Hannah, I'm going to go with you first because you're nodding, so you lose out there.
They are tax efficient, but what I would say really depends on your reasoning for doing it. By that, I mean, just because you watch this video and us accountants say that the benefit in kind is really low, it's really tax efficient, doesn't mean you necessarily should go out and get one. So just because there's good tax rules in place, don't let the tax tail wag the dog. So if you're looking to get a car, that's something you want to do. Maybe you have a staff member that you would like to, as part of their remuneration package, and how to incentivize them. You're considering company car, great. But yeah, don't let the tax tail wag the dog. But they are efficient.
And Mike, is this the same whether it's a car or a company getting an electric van or something like that? That's probably a daft question, but...
No, it's good. So people look at it and it's four wheels and a steering wheel, but a car is different to a van. Electric car is different to a diesel car. And different to a tractor. Let's get a farmer's pit into there as well. So a van is classed as plant and machinery. So that isn't classed as a car in tax rules. Okay, a car is taxed as cars, so that's okay. We're all right. We're on the same page with that one. But yeah, there is a distinct difference between a van and a car when it comes to tax. That's why a lot of people you see driving around in vans, whether it's they're like not just builders, but other people as well, because they have a lower tax break. You pay a fixed rate of £3,700 for a car. So essentially, with a company car, if we start with that bit, and then we can get Hannah's got some workings on different cars and stuff. But the way it works is, so you get a company car. So if an employee gets a salary, gets a wage, they get taxed on their pay slip and everything's fine. You've got money moving across into their bank account and it gets taxed on the way. Whereas what my analogy of this is, years and years and years ago, people were trying to work out how to not put money through on a pay slip. So they were like, we'll buy you things so it comes round the corner. You enjoy it because you would have paid for that personally out of your post-tax money, and we'll pay for it. And obviously HMRC looked at that and goes, well, actually, no, you're skipping us out there. You've missed a bit. So what we'll do is we will equate to converting that into what essentially that salary would have been for that asset, that benefit. So whether that's medical insurance, whether that's up in London, the new suits and stuff that they would buy their staff as a bonuses and stuff like that, or cars, vans. So they work it out, and there's an equation and bits to how it works out, and then it gets added on to your salary, and then you pay tax on that. So, and that's it gets adjusted through your tax code. So again, it still gets taxed through your pay slip. But it's that added bit. So you could have a 30k salary and the car equates to an extra £5,000. So it just bolts on top, and then you get taxed on that from there.
Okay, fine. Yeah, because I remember there was always the discussion about whether you go for a company car or whether you get your own car and you're basically expensing 45 pence a mile or whatever. And there's a sort of a point where one's better than the other. And I'm not expecting you to give us that magic formula, but
we'll sit on the fence again and go, and it will depend.
Yeah. And I mean, but there lies an interesting one, is that one I remember going back quite a few years, is that someone said, yeah, don't bother getting a company car unless it's electric. And because of the tax efficiency of them, then it's worth it. Is that still the case, or does that comment ring true at all anymore?
I think it depends on the car. In most instances, it's going to be much more tax efficient. Well, it is going to be more tax efficient for you to have an electric car or a hybrid car with emissions lower than 50. What does G/km stand for?
Grams per kilometre.
Kilometre. I thought it was kilometre. I was 100% sure.
Yeah.
So to answer your question, generally speaking, yes, but it also depends on the car. You know, if you've got a petrol car, that's going to be more efficient than a diesel car. If you've got a diesel, but you've got a V8, yeah, you're probably in a bit of trouble there, and it's not worth it.
No, absolutely. Yes, yeah, nice noise and everything else on it. Yeah, agreed. I mean, is now the right time to bring up your workings that you've delightfully done for us, Hannah? Or is there more to say on it before I bring those up?
You're not going to put it on screen, are you? Have you checked the spelling?
No, it's fine. It's potentially, this is just a bit of fun, just to help us, okay? I mean, I cannot put them on screen if you'd prefer, Hannah.
Right, go for it.
I don't mind. Go for it.
I love the fact that Mike just goes, yeah, it's fine, go for it, it's fine. Right, hang on, I did have it ready to go, but it disappeared. Okay, so let's put this up there. So it is, I know for us three in the studio it's a little bit smaller, but for anyone else, you can take this up to full screen, you'll be able to see it. In fact, to tell you what I will do, I'll make it a bit better. I'll go to that one and hide us all for a second. So Hannah, you're going to have to take the can for this one, because you created us. Speak us through. There is a second page, don't panic. The other bits of information are on the next page.
You're all right.
What are we looking at here?
So what I tried to do, going across the columns first, there's certain things that we need in order to work out what the benefit in kind is. And that is the cost, the admissions, and the rate, right? And the rate is determined by what the admissions are. And then really it was just a bit of fun to put in the brake horsepower and not to 62. So I have tried. Yeah, it's because of the site that I went on a leasing site actually that does business cars, and it does 0 to 62 for some reason. I found that a bit annoying. But I also tried to group these together in things that, you know, cars I thought were kind of comparable, but I don't know that much about cars. So if I've got that wrong, please let me know. But I basically based it on the shape, size, and the cost. So yeah, starting off with a Porsche. Now, normally at my gut, if someone said, oh, I want to get a company car and it's a Porsche, I'd say no. I don't know about you, Mike.
Yeah, no. If it's to be honest, my default is it hybrid or electric? No, I don't put it through.
Yeah, no, exactly. So what I did, I put the Porsche Taycan and the Panamera, and I looked at the V6 and the V8, and the sort of top three lines basically show you a comparison of what the benefit in kind would be. And in the last three columns that have got grey in the top title, they're greyed out. You've got the benefit in kind. So the way we work out the benefit in kind is we take the cost of the vehicle.
When it's new.
We look at when it's new, yeah. That's a really, really important point as well. We take the cost of the vehicle when it's new, and we look at the emissions. And those emissions will fall into a table that the revenue produce, and it'll tell us whether it's 25%, blah, 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 blah. And in this case, so let's look at the Panamera, the V6. In this case, you've got a high admissions, 243, and the rate is 37%. So when you multiply those up, you get a benefit in kind of £32,000. Now, where do we take that from here? Let's say
on top of your salary, that 32% is that bit that bolts on top.
Yeah.
So in terms of where we take it from here, say you were earning a salary of 50k, right? We need to add the 32k on top. So you've now got taxable income of £82,000. Now that's a huge jump. You've gone from a 20% taxpayer to a 40% taxpayer just by having that benefit. The tax on that looks like, I mean, for the Porsche, the 20% column, you just shouldn't really calculate it because it's going to be very unlikely that you're going to be in that band anyway. But you're going to be paying £12,820, 65 pence in tax for that car each year. About that you put, so when we talked about the 86, we talked about the cost when you buy it, or the market value, sorry. That is the value that's used every year. The revenue doesn't care that you're 7 years down the line now. That is the charge each year. That is why it is so expensive to have higher performance cars, or less. That's not fair actually to say, because which you'll see now with the Porsche Taycan, but cars with very, very high emissions, it doesn't pay. And this is all part of HMRC's fiscal policy. They're trying to get us to be cleaner, make cleaner choices, i.e. buy electric.
Yeah.
And let's assume as well on this that for most of the time for our client base, it's owner managed businesses. So the company that they own is paying for the car for them to benefit. So they've got this personal tax over here. Okay, the company's got a blooming big tax as well, because they pay national insurance on that 32k at 13.8%, or it might be a smidge over now. So they've got a massive tax bill in the company as well. So there's two sides to it as well. We're looking at it because it's on the income tax side, and that's the area we're at. But actually, there's also a company side. So you've got that tax bill, and the company's paying for the car as well. So, and some people will earn silly big money and absolutely fine. They go for it because they don't really care. The tax bill's not anything to worry about. And if they got a 20 grand tax bill, they pay a 20 grand tax bill. But for a lot of people that are looking at it, you add all that up together and you go, right, they're paying £1,000 a month for the lease, or £2,000 a month for the lease of the Panamera. Then they're paying 13 grand personal tax. They might be paying 9 grand company tax. And it comes a big figure. And that's why you don't see many of them around unless there's some companies that are making multi-million-pound profit.
And by the way, we're not picking on Porsche. That's just a high quality, nice sports car, just to make sure that we're not getting in any trouble there. Well, okay, so let's look at keeping it Porsche for a second, the Taycan. So that's an electric vehicle, hence the zero emissions. 530 brake and 4 seconds up to 62 mile an hour. Love that one. The benefit in kind, I never understand why that, because benefit in kind sounds like a positive, but it's not, is it? Like you say, it's the bit that's thrown on top again. Is only 1,840 on your salary. So if you're in that 40, you're talking just £736 a year tax for that.
Yep.
Which is
big change.
And on the company side, like Michael just said, for the employer's NI, significantly less than it would be compared to the V6.
Yes, exactly right. Which is quite a big deal. Now, if I take this down to Tesla, for example, though, that's even lower again. And that's because of the price of the vehicle.
The list price coming down, that's it. So that's only got a 46. So you got that 2% on the 46 equates to just under £1,000, 938, and that's where that little bit gets added on. And that's why I reckon if you stopped all the Teslas and the Polestars driving up and down the road, over half of them would be company owned, because for a company owner, if they're paying for a car anyway personally, they can get the company to pay for it. I got a client, he's got a Polestar, he's paying £400 a month, and it costs him, he's on basic rate tax, so £190 a year and £400 a month lease, and he's got a car fully paid for by the company. Fully paid for. That's the servicing, the MOT, tyres, maintenance. It's all paid for by the company. So why wouldn't you? If you're at that point, why wouldn't you?
And don't forget as well, so the office I'm sat in right now, we have electric charging points. It is not currently a benefit in kind to charge a car, where it would be if you were given fuel by the company, but you can plug in outside and there's no benefit in kind charge. And as a business, you're paying the electric bill, you can still, that's a wholly and exclusively business expense, offsets against your CT.
So and Chris, when you get to the point where you go, there's another thing, right?
Yeah,
so
always.
This is so these are the costs just to have the car available for you to use, okay? If you then go and drive it personally, okay, you've still got to put your own fuel in it, or if the company pays for your fuel, that bill on the right-hand side gets considerably higher again.
Yeah, it's worked out on a flat rate, which is absolutely extortionate.
Which, I've never quite got, because the reality is that, well, I mean, when you consider that even driving to and from the office is classed as personal miles, unless you've got a home office as well or something to that effect, but that means that I'm always going to be using my company car for personal miles.
Correct. And again, that's where a van comes into a different in tax law, because a van being used from home to the office or home to the workshop is not classed as personal.
Okay. Yeah. What were you really referring to on this, though? Because you were saying about fuel, and we're saying that we wouldn't be buying fuel for this.
Not for electric. Yeah, go on, Pam.
No, go on. You finished.
So if you say you go and if we're talking electric cars, if you go and charge up, I don't know what the phrase is, I haven't got one yet. That cost that's still put through the company, so there is still costs of charging and bits like that. And if you're charging it at the office, you're plugging it into the electric bill's going up, so you're providing an energy source for the car for you to drive privately. And again, but that's all covered within this. But if you had a Panamera and you went and put 150 quid of petrol, super petrol in it, then you have to apportion for like personal private, and either you kind of pay back the personal element, or you pay for all the fuel personally and you charge 12p, 13p, 14p a mile to cover the fuel for the business bits instead of the 45p. And it just or you just pay for the extra tax and just bang it all in and just close your eyes and hope for the best.
Right, clear as mud. But in essence, though, going back to my original question, I asked the question: does it pay? Excuse me. If you're going to have a company car, if it's electric, yes, it's still worth it, and that does ring true, judging from those figures.
Yeah, I think so. And I think what I'm trying to show here is that, this is why I put the horsepower and the 0 to 62 on there, because they can be just as fun, All right, you haven't got a manual shift gearbox, short shift change, anything like that. But you can have a performance car, through the business with a minimum tax liability compared to that of, the Porsche of V8. So, and then below that, we've gone for the Range Rover Sport, really, really common car for a business owner to say, I want the Range Rover Sport. That and the Defender. So I've benchmarked it, put it against the iX3, because, same sort of price point. I did consider putting the Jag in there as well, but I decided against it. But, look at the comparison, even the hybrid. So hybrids are a little bit different in that a fully electric car is just straight away, it's got zero emissions. From HMRC's perspective, when it comes to a hybrid car, you're actually looking at what emissions it gives out. If it's under the 50 grams per kilometre, then they just class it as zero emissions for the purpose of calculating a benefit in kind. If it's over that, then it looks at what is this, how long, how much range can it go electric? It looks at things a little bit more detail. So hybrids, you have to be a bit careful, because you could be on the spectrum where it's still quite costly, or you could be the other way where it's very, very efficient. But there's, quite a spread of cars. I don't really know about cars. I drive a Seat in a pretty dress. So I pulled out what I can from here, but I think you can see that, there are options available that should be palatable to most people who are conscious of their tax exposure.
And is there any difference between whether the company, because and I assume we're talking company, purchase or lease it. I mean, presumably they're always going to lease it, aren't they? Because you get the deal with, like you said, Mike, with the maintenance, the tires, the everything else, and you're always just going to lease it. That doesn't make any difference to these equations, does it?
No, and a lot of people that we get asked quite often, do I buy or lease an electric car? And the general consensus coming from clients to us, like we're not car experts, but is that because the industry is moving on so quick, people don't want to be buying a car and being sat with it, which again, it seems to be what the market is, because they're having to lease them, they're having to just kind of give them out there as quick as possible because people aren't buying them. So they have to lease them now because they want one that's might do double the range in 3 or 4 years' time. They don't want to be sat with one that then's only doing 250 miles and becomes a impractical nightmare.
Yeah, indeed. And I mean, there's all sorts of potential future fuels that could come into this, so we'll wait and see. But that kind of makes sense to me there. I'll just double check. Do we need to? I think we've covered all of this as well. I love the bit of fun where you're talking about Rob, the cars that he can fit in as well. And
Put the answers on there, should I?
You know, he's 6'5", and you still reckon he should fit in a classic Mini and a Toyota Aygo without a sunroof. I'm not sure he would, you know.
Does the Mini involve taking the front seat out?
I pressed him on this because I thought there is no way, absolutely no way. But he said with the Mini, the seat is very, very close to the floor and the steering wheel is angled upwards quite, so he can get his knees in.
Okay, all right. I love the GT40. I agree. That'd be a struggle, the GT40, unless he removed the doors.
I could fit in American.
Absolutely, absolutely.
I don't think you and I would have any trouble
like that, actually, trying to get the steering wheel above me.
That lad of the mirror.
In essence, I mean, is there anything we haven't covered on the tax efficiency of electric cars? No. That's fine. I mean, but in essence,
at the end of the day, if someone's getting like this and they get to the point, oh, that seems to make sense, they're going to pick up the phone to us. We're going to have a conversation, and then if there's any other little bits, we're going to let them know what that is anyway. But it's just, this is all about just trying to get people to understand that it's a regular question. Shall I, shan't I? What is it? What are the benefits? We try and let people know each time. We go through a little, kind of not like a checklist, making it formal, but like, what about this? What are you doing with this and that? So we're asking the questions. So most of the time they're coming out when we're meeting clients, but this will spark a conversation or a thought going, oh yeah, let's finally go for it. I can see the numbers. I can see that it works. And then like we get quite often clients come through. I've got a couple of quotes of some cars. What do you think works? And we have a look through, have a chat, the pros and cons, and off they go.
Which makes sense. I mean, because I have a personal car and I just expense 45 pence a mile. How does it work if I personally had an electric car then? You know, is it 45 pence a mile can't be right? Sorry, Hannah. Sorry.
No, that's all right. There's some advisory rates, which effectively just get you. It all depends on the car on what you've got, but essentially there's a small kind of contribution. So for example, instead of reclaiming 45p a mile, it could be 9 pence per mile, for example, but it depends on the car you've got.
And there's two bits to your 45p. There's two bits that make it up. There's one which is like the fuel element, and then the other bit which is the kind of the repairs and maintenance and the cost of the car price. So generally speaking, you've got, I think it's like between 9 and 14 pence covers the fuel, depending on your car, and then the balance is on there. And that's why when you get past 10,000 miles, it goes from generally 45p to 25p. And that's because they're going, well, you paid, most of your car's been paid for by the first 10,000 miles. It's just mainly the fuel that we're covering for.
Yeah.
I noticed that they haven't adjusted that 45 pence a mile with the cost of fuel going through the roof, though.
Yeah, there was a big pressure of that. Was it last year, the year before last? But no, it must be the year before last when it was the fuel hikes and stuff, when it was getting up to like nearly £2 a litre or whatever it was then.
Yeah.
So garages are absolutely inundated. So you used to, if something was wrong with your car, I'm used to just popping down the garage and they'd see to it. But you know, weeks for some of them at VW, I had absolutely weeks, and the gearbox didn't work. You know, the more costly repairs, driving them for longer.
Yeah, no, that's very, very true. So in essence, if you're starting to look at the idea of getting a company car, And in fact, if it's your own electric car, have a chat, work out what that rate should be. But in essence, have a word with the team at Optimum, and they'll be able to guide you, advise you, not tell you exactly what to do, but be able to advise you at the very least. And it certainly looks from those figures like it's worth having a look at the electric car. They are tax efficient. There's no question about it. We're not getting into all the other discussions about electric vehicles and everything else. That's for a different audience from a different group of people to us as well, to be honest with you. But it's an interesting area without question. Personal tax, hope that was useful for everybody as well. Talking about get ahead of the game, get saving, start getting yourself ready for payment on account and all of those sorts of things. And remember, it's based on the success you had last year, not what you've got now. So get the save in there rather than waiting until it's too late. I think that summarizes it well enough, guys, doesn't it? See, I do listen.
Yeah, you do.
I know I do, because I get headache afterwards trying to learn everything from you guys.
Go for a kip after.
I will, absolutely. Listen, thank you so much to you both for coming on again. Hannah, I know that you sound like you got a little bit of a cough there, so a lot of that going around. So thank you for still coming on.
That's okay.
Internet was a bit of a struggle at times there, wasn't it? But we'll hopefully it came across all right for everybody. And Mike, thank you, mate. And I know, as I say, I saw you this morning, and you were very bloodshot eyes, to say the least, after the tough January. But we made it. We got it done. We've got it out there, and we'll be back again in a month's time, won't we?
Yep.
Yeah, thank you so much for hosting.
No problem. So from us and from me and the team at Optimum, thank you for joining us. You can watch this back. If there's questions that come out when you're watching it back, not live, then you can put them in there, but you've always got a risk that they might get missed. So drop emails to the team, and they will be able to find out. While I talk about emails, do drop a line to marketing@optps.co.uk, and that will get you included in the email list to receive the newsletter. The monthly, isn't it?
Quarterly.
Quarterly, sorry. I was making work for you there, wasn't I? Quarterly newsletter, and I have to tell you, it's really good. Really, as a business owner, it's really useful, all that sort of stuff to see. So jump on that. If you're not watching this on YouTube, make sure you go to youtube.com/@OPT. Have I done that wrong, haven't I? No, it is Optimum PS. That was because I created that. Optimum PS. So at Optimum PS, as in professional services, and hit subscribe so that you'll be able to get all the different information that's up there. In terms of the website address, it's optps.co.uk, and email for Mike is mblaken@optps.co.uk, and for Hannah, it's hmatthews@optps.co.uk. So drop them a line and let them know. Thanks to John Lacey for the thumbs up. Good to hear that we kept him focused all that time. And we'll see you all next month. Cheers, team.
Cheers.
Bye. Bye.